I've sat across tables with some of the most sophisticated allocators in the world. Pension fund managers, sovereign wealth operators, family office chiefs who manage more money than most countries hold in reserve. And in the last 18 months, almost every single one of those conversations has circled back to the same asset. Not equities, not bonds, not crypto. Gold. Physical, boring, ancient, and right now absolutely essential. I'm not saying this because it's trendy. I'm saying it because the data is screaming it. The macro environment is demanding it. And the investors who are ignoring it are making a mistake they will spend years trying to recover from. So before I get into the full argument, I want to ask you something directly, and I genuinely want your answer in the comments below. How much of your current portfolio is allocated to gold or gold-related assets right now? Give me a percentage. 0, 5%, more? And tell me why. Because I think the answers are going to reveal something important about how most people are thinking about risk in 2026, and I suspect the majority are dramatically underexposed. Comment below. Let's have that conversation. Now let's build the case from the ground up. Gold has been a store of value for over 5,000 years. I say that not to romanticize it, but to make a specific point. No asset with a 5,000-year track record gets that by accident. It earns it. Every generation, in every economic environment, across every geopolitical disruption, gold has done one thing consistently. It has preserved purchasing power. That's not a sales pitch. That's a historical fact. In an environment where purchasing power is being actively eroded by fiscal policy, currency debasement, and structural inflation that refuses to fully retreat, preserving purchasing power is not a conservative goal. It is the most important goal. Here's the problem with how most retail investors think about gold. They treat it like a trade. They check the price, they see it went up, they wonder if they missed it, they wait for a pullback, and then they do nothing. That is exactly backwards from how sophisticated allocators approach it. Gold is not a trade. It is a position. It is a structural allocation that serves a specific function in a portfolio. It is insurance against the failures of the financial system itself. And the cost of that insurance, when measured against the risks currently present in global markets, is not just reasonable, it is arguably cheap. Let me lay out the macro environment clearly, because context matters enormously here. We are operating in a world where the United States national debt has crossed $35 trillion and continues to climb, where the interest payments on that debt alone are consuming a historically unprecedented share of federal revenue, where central banks globally have been net buyers of gold for multiple consecutive years, not net sellers, not neutral, net buyers, at a pace that represents a structural shift in how national reserves are being managed. When the institutions that print money start aggressively buying an asset that cannot be printed, that is a signal, a serious signal. And if you are not paying attention to it, you are missing one of the most important macro narratives of this decade. The psychology of gold aversion among retail investors is fascinating to me. People are deeply comfortable holding assets they can watch on a screen, assets that move fast, assets that have exciting stories attached to them. Gold moves slowly. It doesn't have a quarterly earnings call, it doesn't announce product launches, doesn't trend on social media, and that perceived boringness causes people to underweight it dramatically. But here's the insight. The things that make gold boring are precisely the things that make it powerful. Its value is not dependent on a CEO making good decisions. It is not dependent on a board approving a buyback. It is not dependent on a government maintaining fiscal discipline. It just exists. And right now, in a world where institutional confidence in paper promises is quietly eroding, something that just exists has enormous value. I want to address the gold bears directly because their arguments deserve a response. The most common one is, gold doesn't generate income. It just sits there. That's true, and I've made that argument myself at different points in my career. But that argument was built for a different interest rate reality than the one we're navigating. The anti-gold case is strongest when real returns on bonds are positive and meaningful. When you can park capital in a 10-year treasury and earn a genuinely positive return after inflation. In that environment, the opportunity cost of holding gold is real and measurable. But when inflation remains structurally sticky, when the real yield picture is murky, when credit risk and sovereign debt is rising quietly, the opportunity cost argument weakens considerably. The income you're giving up by holding gold matters a lot less when the income-generating alternatives carry more risk than they appear to on the surface. The second bear argument is, gold already ran, you missed it. Let me push back on that hard. Timing arguments about gold are almost always wrong in both directions. People said you missed gold at $1,200. They said you missed it at $1,200. They said you missed it at $2,000. People making the same argument now, at current levels, may be repeating the same historical error. The case for gold in 2026 is not a price momentum argument. It is a structural argument. The same structural forces that have been driving institutional accumulation, currency debasement risk, geopolitical realignment, de-dollarization trends, sovereign debt concerns do not resolve in a quarter. They resolve over years, if they resolve at all. And as long as those forces are active, the macro case for gold remains intact, regardless of where the short-term price has been. Now let me talk about how I think about gold as a portfolio instrument, because the allocation question matters as much as the decision to own it. The traditional institutional guidance for gold has been somewhere in the 5 to 10% range as a portfolio anchor. In normal environments, that's a reasonable baseline, but we are not in a normal environment. Several allocators I respect has moved meaningfully above that range, not because they expect gold to triple, but because the correlation structure of traditional portfolios has broken down in ways that are genuinely concerning. When stocks and bonds fall together as they did in 2022, the theoretical diversification benefit of the classic 60-40 portfolio evaporates. Gold historically does not fall with equities in risk-off environments. It often rises. That negative correlation property is not guaranteed, but it has been persistent enough over long periods that it earns a structural role in a serious portfolio, not a speculation. A structural role. I want to spend some time on the forms of gold ownership, because this matters more than people realize. Physical gold, bullion, coins, allocated storage, is the purest expression of what gold is supposed to do. When you own physical gold, you own something that has no counterparty risk. No company can go bankrupt and take it with them. No institution can freeze it. No policy decision can dilute it. That is not a fringe survivalist argument. That is a legitimate financial characteristic that has real value in a world of elevated systemic risk. I maintain physical gold exposure as a core position not because I'm preparing for civilization to collapse, but because removing counterparty risk from a portion of your portfolio is simply good financial architecture. Gold ETFs, specifically those backed by physical gold with audited holdings, are a practical and efficient vehicle for most investors. The expense ratios are low. The liquidity is excellent. The correlation to spot gold is tight. If you cannot or do not want to store physical metal, a well-structured gold ETF accomplishes most of the same strategic goals with minimal friction. What I would caution against is synthetic gold exposure, products that use derivatives to replicate gold price performance. In a normal market environment, they function adequately. In a genuine stress event, the exact scenario where your gold exposure is most important, synthetic structures can behave unexpectedly. Own the real thing or own a fund that owns the real thing. Keep it simple. Gold mining stocks are a separate and more complicated conversation. I've held them, I've traded them, and I have a nuanced view. At their best, mining companies offer leveraged exposure to the gold price. When gold rises, miners can rise significantly more. At their worst, they are operationally complex businesses with country risk, management execution risk, cost inflation risk, and hedging programs that can actually reduce your gold price exposure at exactly the wrong moments. I do not treat miners as a substitute for gold. They are a complement, and a selective one. If you are adding mining exposure, focus on companies with low all-in sustaining costs, strong balance sheets, and jurisdictional exposure to politically stable regions. The leverage is only valuable if the company survives long enough to benefit from it. Now I want to talk about something that doesn't get discussed enough when people debate gold, the currency dimension. Most Western investors think in dollar terms. That's natural. But a growing percentage of global trade is being settled outside the dollar system. Not because the dollar is about to collapse. I want to be precise here. I'm not making a dollar collapse argument, but because the multipolar economic reality that has been building for 15 years is now actively restructuring reserve asset preferences among major central banks, Russia, China, India, Brazil, and several Middle Eastern sovereign funds have all been meaningfully reducing dollar-denominated reserve exposure and adding gold. These are not small actors. These are major economic powers making deliberate long-term strategic decisions about what holds value when the geopolitical architecture shifts. When you see that pattern, you have to ask yourself why. The answer is not complicated. They are hedging against a world where the dollar's reserve currency status is less dominant than it has been. Gold is the only neutral reserve asset that every country in the world can hold without political exposure. That is a property no other asset possesses. Let me contrast how the average investor thinks about this with how I think about it. The average investor looks at gold, sees it doesn't pay dividends, sees it doesn't have an earnings report, and parks the idea in the maybe someday file. Someday never arrives. The portfolio stays concentrated in equities, tech-heavy, dollar-denominated, positively correlated to everything else. And when the stress event comes, and it always comes, every position moves in the same direction simultaneously. The wealth-focused investor looks at gold differently. They see it as the only major asset class that is simultaneously a currency, a commodity, and a safe haven. They see it as the thing that performs when their other positions are suffering. They see it not as a way to get rich, but as a way to stay rich through environments that destroy portfolios built on optimism alone. Here's the psychological trap I see constantly. People are reluctant to allocate to gold when the market is going up because it feels like a concession, like admitting that things might go wrong, like taking chips off the table. But that framing is fundamentally incorrect. Diversifying into an uncorrelated asset during a market upswing is not pessimism, it is precision. It is the act of saying, I will not sacrifice the upside of my growth positions, and I will not leave myself completely exposed if the macro environment deteriorates. You can hold both. In fact, holding both is the only rational response to genuine uncertainty. And if there is one word that accurately describes the global macro environment in 2026, it is uncertain. I've navigated enough market cycles to know that the most expensive thing an investor can do is require certainty before acting. By the time the case for an asset is certain, the price has already moved to reflect it. You buy insurance before the storm, not during it. You add gold when it feels unnecessary, not when it feels urgent. The investors I've watched build real, lasting wealth through multiple cycles, through policy changes, through geopolitical disruptions. They all shared one behavioral characteristic. They allocated to protection before they needed it. And then, when the disruption came, they weren't scrambling, they were repositioning from a position of strength. The bottom line for 2026 is this. The macro environment, sovereign debt levels, currency debasement risk, geopolitical realignment, central bank buying patterns is more favorable for gold than it has been at almost any point in modern financial history. The psychological environment, retail underexposure, consensus underweighting, dismissiveness based on it doesn't pay income, means the crowded trade is still on the other side. And when the macro fundamentals point one direction and the crowd is positioned the other way, that is precisely the kind of asymmetry that serious investors look for. I'm not telling you to put everything into gold. I'm telling you to think clearly about what percentage of your portfolio is protected from the scenarios that would hurt everything else simultaneously. If the answer is zero or near zero, that is a risk management problem. Solve it. Allocate deliberately. Own the physical reality, not just the paper story. And then hold it with the patience that this asset demands and rewards. If this made you rethink your current allocation, share it with someone who needs to hear it. Drop your gold percentage in the comments. I want to see where people actually stand. And if you haven't subscribed yet, do it now. The conversations we're going to have this year about where capital is actually safe are going to matter more than anything I've produced before. I'll see you in the next one.